Hello, everyone. I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. Well, it's certainly going to be an interesting week in the markets, as tomorrow we finally get the rate announcement from the Fed that we've been looking for. The market has really kind of paused, and even though we're up at all-time highs, this meeting, the investors are really putting a significant amount of weight on to see how much the Fed cuts rates. And there was a point in time a couple of weeks ago that the market was pretty sure they were going to cut a half point. That changed down to about a quarter point. So that's kind of the expected cut from the Fed. And then you've got, people on either side of that saying that they're going to cut 50 basis points and others saying they really shouldn't cut anything. And what I've done and told clients, including in the Know Trader clients in last week's report, which comes out Thursday mornings, is that you really want to be prepared for some adverse moves in the market in either direction. In other words, some surprise moves, whether we move up briskly or move down briskly, but you want to have a game plan in place because things can change quickly after tomorrow's announcement. And it's not just the announcement that comes as far as what the rate cut is, but it'll also be the press conference afterwards and the tone that Fed Chairman Jay Powell discusses and how he says certain words is what I think everybody's really going to be looking into. Is this going to be a one and done cut? Is he opening the door for further cuts? Unfortunately, this has become highly politicized too. The president thinks that, rates need to be dramatically cut. The economy is not at this point necessarily saying that we need a cut at all. And yet you have economists out there who are continually saying that we're on the verge of a meltdown and a significant recession. Others saying that if the market comes off, it'll be fairly mild. And you've really got people on both sides of this, which is why we've taken down some long exposure. We're still net long. But over the last 2 weeks, I've told clients to lighten up some exposure as we get close to my 30-32 S&P target. So we'll take a look at that in a few moments. And what I wanted to do today also was talk about some over-owned stocks that are in the marketplace. And here's a graph that came out of yesterday's Wall Street Journal, and essentially what they're calling crowded trades. So if you look at this, it says that Visa is held by 60% of funds out there, which is, an incredible amount of funds holding single names. And Facebook and United Health are over 55% held. You can see Alphabet is probably about 54% of the funds hold it, and so on. Look all the way on the far right, and Salesforce.com, ticker CRM, has just about a 2.2% weighting in the funds relative to its own weight in the S&P. So these are names here, and we'll go through a bunch of them today, that if they miss, if there's a negative announcement, if anything doesn't go as planned, these are highly vulnerable names for pullbacks because they're so over-owned and overweighted in the funds. So you can see at the bottom, we're going to look at a bunch of names today just shortly, but some of these we happen to have looked at last week. So for instance, Facebook we looked at last week. I think we did Visa also. I think we did Google and MasterCard. So I'll try to focus in on the ones we didn't look at last week to start off. And then if we have time at the end, we'll go back and revisit. As we do most shows, we also start off looking at how sectors have performed year to date. Unfortunately, I don't have last week's slide with me. I've been traveling a lot, so I've got different PowerPoint presentations in different places. So unfortunately, I don't have last week's to compare to, but clear to still see that technology, the magenta colored sector is still this year's darling, outperforming the S&P by 13.6% this year. Second place is real estate over on the far right at 4.10%, and creeping very much close to it is consumer discretionary, which recently got a bid and has increased its outperformance of the S&P. And of course, on the downside, nothing's changed. Healthcare and energy continue to be the real dogs of the year. In fact, energy as of last Friday's close has made if you look at XLE divided by SPY, it is on not only a new 2019 relative performance low, but you have to go all the way back to the year 2000 that we've been at this ratio. So this is essentially, the energy sector has been a long-term disastrous place to be invested in relative terms. Only twice in the last 10 years has energy outperformed the S&P, but since 2010, which is when it peaked versus the S&P, it's basically been down. And again, we're on 19-year lows in relative terms. So it doesn't mean you can't make money being long some energy name, but you could have picked any other sector and had a much better chance of making money than picking names in energy. So that's stuff to continually pay attention to. Let's take a look at, let's go to the charts. And as we also always do, let's start off by looking at the S&P. And a couple things bother me about the market up here, which is why we've decided to lighten up. First off, our target to the upside for a couple months has been 30.32. And we got as high as about 30.25, 30.26, something right there earlier this week. So we've all, for all practical purposes, gotten there. And the 13s that you see on top of price action in the middle of July is a warning signal that you're potentially late in the rally and that the risk of first putting on new long exposure is very high. Now, this is a daily chart. If I switch, and let me see if I have it loaded here, otherwise I'll just manually switch it. Yeah, I do have it weekly. So what I'm concerned about too is that the weekly charts are also on upside exhaustion signals. And if you look back in time, and we go back to early 2018, basically on the all-time high at that point, before we dove the early part of last year, you had an upside exhaustion signal suggesting, again, doesn't mean you short it, but it's saying this is a really bad time to be a buyer in an uptrend. You had another signal here at the end of June, and for at least 3 or 4 weeks, you sold off from there before moving higher. Then you had, of course, the fourth quarter collapse, especially in December. And then it's made its way all the way back. And what's of concern here are these both aggressive and standard sequential 13 sell signals. And this, of course, is a model that through my work at In the Know Trader, I give you listeners to both this podcast as well as my individual investor newsletter clients from inthenowtrader.com access to models that you cannot typically get access to. These are institutional models. Plenty of institutions know where these signals are, play off of them, and you cannot find this information in hardly any other written newsletter, podcasts, etc., that has, first of all, even has access to them, let alone the success that we've had in interpreting the signals. This year, my institutional newsletter is up as of mid-July. I think it's 62% on invested capital. And we're not in the market all the time, so we select our trades very carefully. But whatever money you've put to work this year on our formal recommendations, if you took all our formal recommendations, and there's only about 15 of them or so that we've had so far this year, you'd be up 62% on the capital that you allocated to those trades. So it's been a huge success, and something that why I continue to do the In the Know Trader newsletter. Instead of solely focusing completely on my institutional clients, which of course I use this for too, but in the newsletter we give you my thoughts on the S&P each week, plus every week we come out with a new ETF trade. We don't trade single stocks in the No Trader. We only do ETFs to remove single stock risk, and we play the markets that way. So this is my concern for the market now, is that after all this time, again, we have double weekly sequential 13 signals and double daily. So again, if we go back to the daily chart, double daily. So when I get multiple time frames giving me the same type of exhaustion, and we're basically right up against the target that we put out at the very beginning of June as 30.32, again, it says to me, I want to be careful. I want to kind of pull down exposure. And if the Fed comes out with a bullish number tomorrow, I'm still willing to sell and lighten up long exposure anywhere from 30.32 up to 30.64. So basically another percent or so, 1.5% higher from where we're trading now. The S&P right now, as this is being recorded, it's about 10:30 in the morning on Tuesday. We're trading exactly at 3,012 right now. So anywhere from current up to about 30.64. I'll just kind of something close to where that line is. I'm still willing to reduce long exposure, not take it down to zero, definitely not going short, but I don't mind taking some off the table here. On the downside, let's say we don't get the rally and we just kind of fall on this news. I've got two levels of importance that, depending upon if you're a tactical trader or more of a position trader, that give me warnings about being continually thinking that this bull market has room to go. On the daily chart for, let's say, medium-term players, you can see I have an ellipse here that I'm highlighting now with my pointer. In fact, we'll take the other one away just so there's no confusion. So right in here, there is a horizontal line at 29.11 in the S&P. If we properly close underneath 29.11, and there's rules for this, and in the No Trader know what the rules are, so it's not just breaching a level, but it's how you breach the level. If we close under there properly, I'm going to far more hedge up long exposure. In fact, potentially fully hedge up long exposure, because if we get down under there, we are both, you're certainly confirming these 13 sell signals, and you're also back underneath that, we'll say 2950 plus or minus 10 points in the S&P that had multiple highs going back to January of 2018. So we would have come back underneath what was at least a double top, almost even a triple top up there. So that's my line in the sand. And I realize that it is just above the uptrend line from, let me see, this was from the Christmas lows. But I would really be concerned, because I'm not sure that that trend line is going to hold at all. But that, that to me gives the market some room to breathe, a chance to even break back under the 2950 level. But it would still need to come off another 1.5% before I'd say, okay, time to hedge your books. And as I've been writing in the No Trader clients for the last several weeks in anticipation of this upcoming Fed meeting, there's a really easy way to hedge your portfolio instead of simply selling out of your stocks and incurring a lot of commission for all these different names. If you have a portfolio that's fairly correlated, you have a broadly diversified portfolio that's fairly correlated to the S&P 500, instead of dumping out of your names, you can simply short SPY, the spiders, which is the ETF that tracks the S&P, and you can do it in any amount of exposure, dollar exposure that you want relative to the dollar exposure you have on being long the market. And if you're not comfortable shorting the S&Ps, there's an ETF ticker SH, which if you buy, essentially goes up in value as the S&P goes down in value. So there are really easy ways to hedge your portfolio without dumping out of stocks and figuring out which one should I get rid of. You can just short the market or make money being long that SH ETF if the market goes down. So I think, there's never been a better time as an individual investor to be able to hedge a portfolio without dumping out of stocks and incurring tax, liabilities potentially. Just buy an ETF that goes up in value when the S&P goes down in value, or short spiders. All right, let's take a look at names. And let's put up a fresh new chart. Oops, make this smaller for a second, put up a new chart. We'll max out the chart. And let's put up our first name for the week again, that really, widely held names according to Wall Street Journal that funds have significant exposure in. So we'll start off with United Health. Let's look at a weekly chart. And so this has a good long-term, obviously it's been a supreme winner since the 2009 lows. Great chart. Pullbacks always seem to have come to the cloud. Here we actually broke through the cloud, and looks like spring last year. The lagging line from the clouds chart, which is current price, pushed back 26 bars. This is a weekly chart, so it's pushed back 26 weeks, stayed above its cloud. So this is a major warning signal of a potential change in trend. But without the lagging line also breaking through, there was never reason to go short. So you might have lightened up a bit, but this is still holding in there. Notice the peak, the all-time highs made on a sequential 13 signal. There are lots of other 13s along the way that didn't work, but this one happened to. And it did nail the high. ABC down as far as a corrective wave down, and we've come back, and you can see we're kind of stalling up against the top of the cloud here. We had one weekly close above, and then we've pulled back. So this is kind of a neutral name right now. Where are the levels that I'd be concerned on the downside? A Friday close, let me see what it would be. Not this week, but any week following a Friday up close relative to the week before, that closes under 248, opens the door for a move down to 228. So, I pay attention to that. On the upside, should this Friday close above 262 and next Monday gap higher and take out this week's high, then you get a buy signal with a target of 278. So I look back here, I see that we've got basically a double bottom versus the January 2018 low and the April 2019 low. So this is still in a trading range, but with a bullish bias because the long-term trend is still up. So, which means I probably do take a buy signal if it comes to play for, this is a trade, but 262 up to 278 as a possible trade. And beyond that, I would take at least half off there. Because that's getting close towards, where we peaked out, and I'm not sure it's still going to have more. So it's nothing more than a trade in a stock that's going sideways, but certainly hasn't materially broken down. Salesforce.com, the one that the Wall Street Journal said probably has the largest overweight of any name that they looked at. So we're not far from all-time highs. We got very close to hitting the propulsion level that was put in place just last fall. So when we sold down here, the propulsion model said that if we got through 140, almost 141 properly, we would target 167, 168. And the high of the move so far is 167.5. So perfect kind of upside target. No reason not to be a holder of this name, but am I putting on new long exposure? Well, with this here, let's do a better job. With this 13 here on the weekly chart, let's try one more time. There we go. And the 9 counts. They certainly have stalled the market for months now, so they've done their job of identifying that you're exhausted the uptrend. Doesn't mean you can't go higher. And remember, there are three trends in the market. There's up, down, and sideways. So if you've been moving up and you get a signal that says the trend is likely ending, that doesn't mean that you need to go down. It just means going sideways is a successful indicator that the trend has changed. So for now, we've been sideways for 6 months. And again, I'd probably have to see multiple Friday closes above 170 to think that then CRM has the chance of measuring all the way up to 222. And that's, percentage-wise, that'd be a huge move. On the downside, where do I get worried here? Let's see, close by, I really don't see much. Let's look at the daily and just see if something shows up there. Not really. So for risk purposes, I don't want to risk all the way down to the 110 level for where we bottomed last year. In percentage terms, that's huge. I would say almost if there's double bottom here from January and June, kind of near 145. And if we took that out, you think we could go lower, but depending upon how many weeks it takes to get there, the cloud will be right there. So unfortunately, I don't see anything really close by to be an effective sell stop if you own the name. This is something we can revisit post-Fed meeting and see what the market's doing. But I don't have a high conviction sell stop here that's close enough to the market, and that's just the way it is sometimes. PayPal. A couple of weeks ago, we make new all-time high. This one actually is confirmed because now this week we're sold off, and as of at least current price, we've closed less than the close from 4 weeks ago. So as long as this Friday closes less than 1, 2, 3, 4, so the close was, as long as we close beneath 117.16, we're going to have a 1 down here this week, which confirms the 13, which again says very high risk on the buy side. So this is perhaps a better sale than it is a buy. If you're long the name, you've done, again, rather well since it went public in 2015. And there isn't a strong reason to take to exit the trade completely, but I can tell you if you get a little rally off of this this Fed number, anywhere from 117.5 to 126.5 or so is a place that I'm comfortable taking some off the table. And yes, it might mean you incur taxes and stuff like that, but that's at least what these models would suggest. Adobe. All-time highs made a week or two ago. Unfinished counts. We have no 13 or 9 that's active. Measures that we could go as high as 344. So this has been a spectacular name. If so, let's see. Last week was an up close. So if this thing tanks this week and comes off $10, which is what do we got? I guess 3% or so. If Friday closes under 290, let's say 295, and opens lower next Monday, and takes out this week's low, you've got a sale. And in which case, again, if I had this name, I would take some off the table. Despite how good this chart is, it would suggest that we could drop another $20. Now, if another $20 doesn't bother you, then you stick with it. If we broke under 276, then it would suggest that we could get all the way down to 240. So you need to make a decision if you're long PayPal, what you would do if Friday closes underneath 295 and then Monday gaps lower and takes out this week's low. It's decision time because you're talking about $20 move and possibly a much bigger one, depending on how much this market actually sells off. Booking holdings, BKNG. All right, so this is well off its all-time highs. This peaked in first quarter last year. It did not peak. Now I'm curious if it's an aggressive sequential. Let's see. Nope. It did not peak on a 13. It has sold off. The lagging line got under the cloud, as did price action. It still has not broken out to the upside. And I can tell you, just because I know this model well enough, notice in here, we got as high as a 12 count, but it never got a 13 count. That's why you're seeing all these little asterisks. We have to get up to 2136, 2,136 for this to actually get a weekly 13 signal, which to me would say anywhere from 2136 to 2244. So that's about $100, a little less than 5%. Anywhere in that range is still resistance. So we could even make a new all-time high by just a hair and stall there. So I don't mind being a seller on strength up above, 21. There's this 21.36. So anything from, let's just say 21 and a quarter on up, you certainly could take some off the table. Multiple, where's my trend line? Multiple lows down here, right? So the October 2017 low was the same as the lows in December of last year, same as the lows as May, June this year. So good long-term triple bottom makes me think that there's a decent chance this could come up and at least somewhat test the highs. So if I'm long the name, I can hold on to the name. I'm looking, here's the propulsion sell signal. So a Friday close this week under 1814, which is unlikely, but just in case something like that happens, followed by a gap down next Monday that takes out this week's low sometime next week, gets you into a sell with a 1659 target, which again would come down to this level, and that would be the fourth time visiting this level. So that's kind of key. Breaking under this, so this could go all the way down to 1347. So just something, especially something that's made its high a long time ago, to pay attention to. We've got a little less than a minute to go. Let me see. Let's do Abbott Labs, and that'll be the last one we do. So Abbott's on all-time highs. We touched them last week. There's a 13 and 9 in here that got us, I guess, almost a 2-month or more multi-month stall before it got above. Right now, Abbott could get as high as 97.5 on continued strength. The propulsion signal is not worth playing here. The target is too close. Let's just look at a monthly and see if there's anything there. So the monthly had a 13. We are up through the risk level. Notice this climbed up the clouds conversion line. So that's really kind of your first line of defense. So monthly closes under 77. Put me on alert. Otherwise, Abbott's got really good strong chart. If I'm long the name, I love the angle of ascension, but the names that kind of start going parabolic fall pretty quickly too. So I would just, in the back of my mind, keep this level as something to watch, and monthly closes underneath this line. It would be the first time in the last couple of years we would have closed underneath there. And we will be back next week with updates on what the market's done since then. I will flip this quickly and just tell you to reach me, rick@inthenotrader.com, and check out our website. It has lots of videos on it for you to learn more.